Hi, everyone. This is Jason Birak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, we have Jordan Trendsman, creator of the Daily Gold website and the paid newsletter Daily Gold. Thanks for joining us here today, Jordan.
Hey, Jason. Thanks for having me. It's my pleasure.
Thanks, Jordan, and we're glad to have you back, and especially since gold has had this move in the last few months. Gold and silver both have. And before we start talking about specifically gold and silver, because I know our listeners want your opinion on some of the technical analysis, I want to ask you about your opinion of the macroeconomic situation and about this coordinated global stimulus that has occurred in the last 14 days with all the different central bank intervention here announcing basic stimulus packages or infrastructure spending, and how you think that's going to affect the real economy and the markets.
Well, that's quite the first question to start off with, but yes, the macro situation. I think it was something that what it really comes down to is when you have a sovereign debt crisis, as we do, and I say we meaning globally here in the Western world, you have to print money to get through that, and that's essentially what is being done. And so, how the authorities are managing that is they're printing a lot of money at certain points, and then they rest, when inflation kind of gets overheated, and there's many indicators of that, not just the CPI, but, looking at commodity prices, et cetera. When that stuff gets overheated, then the authorities, pull back, and they won't announce anything for a while until the economy looks like it's having some issues. And, essentially looking at the economy, Europe is basically in a recession. China is slowing down substantially. And so, 3 or 4 months ago or so, it looked like that global markets, excluding the S&P, global markets had essentially priced in kind of a mild recession or a soft recession. I mean, emerging market stocks, and commodity prices were down, I don't know, roughly maybe 30-35% or a bit more than that. So those are pretty substantial declines, especially coming a couple years after a massive crisis in 2008. At that point I was thinking the markets are pricing in a mild recession, and then the question was, regarding the U.S., are we going to tip this into a bigger recession, or are we just going to kind of skate along here where we are? And I guess it looks like it's coming to that point where we're not going to go into a deeper recession. Not to go off on a whole tangent, but one thing people have to understand is when you have a big, large crisis and then a very nasty recession as we had, it really takes time after that to have another significant recession. So in other words, we've had such a weak recovery that, given that many bad debts and so forth were liquidated in 2008, 2009, given that, that means it's going to take a while for there to be, another serious recession after that. And so we've had this weak recovery, but we haven't had a lot of, excesses build up in the system. And so I think that's essentially why the economy basically, I like to say we're kind of in a flatlining mode where, we're growing, by 1 or 2% or whatever it is, but it's really not substantial enough to bring down the debt to GDP. It's not substantial enough growth to improve unemployment. And if you look at what happened in Japan, after they had their bust, their economy has been flatlining for a really long time. But specifically, if you look in the 90s, and you look at their GDP growth, most of the time their GDP growth was 1 or 2%, and, occasionally it dipped below 0%. So that's kind of what you have after, in a post-bubble world. You really have a flatlining economy for a long time, until the debts of households come down to a more manageable level, until their balance sheets get repaired. So, as far as where we are in that process, that's going to take a long time, probably another 5 or 7 years or so. But as far as the impact of that on the markets and policy, if you look at how much money our government is spending to essentially, keep some people employed and prevent the economy from really getting much weaker. It's creating, as we all know, these huge debt problems in the coming years. And so what it comes down to for me is, if you look at the amount of debt we have, and it's the same for Europe, I mean, there is a very significant amount of debt that has to be refinanced in the next couple of years. And I think specifically looking at the U.S., I don't have the figures in front of me, but I think it's something like in the next 3 years, like 49% or 59%, something like that. That amount of the debt has to be refinanced in only the next couple of years. And so that's just too much debt to be absorbed by the bond market. And so that's essentially why we're seeing this quantitative easing, because the federal government is not it's not running. I mean, of course, it's running massively huge deficits, but it hasn't been increasing the deficits in the last couple of years, probably because there is some gridlock there with Republicans controlling Congress. And so that's the reason why the Fed and central banks around the world are going to have to continue to monetize the debt, because otherwise interest rates would rise too much, and then if you have interest rates rise too much, then essentially the debt service costs become unmanageable, and that would have very negative economic ramifications. So I know that's kind of a very long answer, but I think that's essentially why we're going to see continued QE, and that's where it looks like where we are here and now. We're seeing the beginnings of another, I guess, inflationary cycle over the next couple of years.
Yeah, I think that's a pretty good summary of things from a mainstream perspective. I mean, from an Austrian perspective, what I would say, though, is that the government doesn't want to cut back any of its spending. I mean, maybe it doesn't want to increase it per se, or there's the gridlock, like you said, to prevent massive increases in spending, although Obama has increased spending during his tenure before the Republicans took back Congress. But I think from that standpoint, like, a lot of the stimulus is to just monetize debt so budget deficits can continue to be run, so Congress doesn't have to set a budget and they can continue spending, and the government can at least stay at a status quo spending levels through this crisis.
Yeah, yes. I mean, I would agree with that.
Okay, well, I want to continue a little bit more on this topic here. And you talked about the real economy in your analysis there, but let's talk about the stimulus's effect then on the asset markets, because the Fed, and this has been this way since Alan Greenspan was at the Fed, and Bernanke is his tutor. No, well, Greenspan is Bernanke's tutor, excuse me, and Bernanke believes also in the wealth effect. And I was wondering if you think then that the Fed is going to continue trying to blow up an asset bubble in the stock market, if you think the general stock market can have more than 20% correction, if the Fed is going to continue to put $40 billion per month into Wall Street's pocket for free to speculate with, or maybe even more than $40 billion if things continue to get worse.
Well, I mean, looking at, we could start with the S&P 500. Something that's actually very interesting about the S&P 500 is if you look at a historical chart, and so, what our listeners could do, they could go to Google Images and just type in historical chart. I mean, everyone knows that the Dow Jones was in this range from 66 to 82, and then it broke out. But interestingly, the S&P 500, and I don't think many people are aware of this, the S&P 500 actually broke out to a new high, not in 1982, but essentially in 1980. So the bear market in the S&P in the 60s and 70s really wasn't that long, or that, I shouldn't say that bad, because, I mean, it was pretty bad. But if you look at a historical chart of the S&P, it looks like the bull market started in 1974 and not 1982. As most of us think with the Dow. And so what does that mean for now? Well, that means, looking back at that chart, that means that with the S&P bottoming in 1974, and it did make a marginal high in 72, but essentially what that means is where we are now with the S&P 500 in the stock market, there is actually some parallel to what we saw in the late 1970s. And so that means that it is possible that the S&P 500 in the next several years could, maybe it moves up to 1,600 or 1,700, and then after that it has we have a recession and it has a 30 or 40% pullback, and then that's kind of the end of the bear market. So I think this is something that a lot of people have missed. But the 70s were not a good economic time. Yet, as I just mentioned, the stock market, its secular bear market, as far as the S&P 500, essentially ended in 1974. And I mean, there was about a 20% downturn, 77, 78, and then about a 35 or 40% downturn there in the early 80s. But if you look at a chart of the S&P, dating back 40 or 50 years or so, it's pretty clear that the bull market started in 74 and not in 82. So that means that, again, I'm repeating myself here, but that means that the S&P, where we are now, it's very feasible that it could continue higher to 16 or 1700. And I mean, that's something I in the last year or so, I didn't think that was going to happen, but now looking at where we are, I think that's possible that the S&P can continue higher. But there are some negative fundamentals that we have to consider. And several of those are profit margins are basically at all-time highs, and profit margins are always mean reverting. Secondly, interest rates are very, very low, and so if we get interest rates start to rise, then the debt service costs of companies is going to increase. That hurts their profitability. And then third, if inflation really starts to set in, that also cuts into profit margins. So, but with these types of things, Jason, they may not start to negatively impact profits for, maybe like another 12, 18, or 24 months. And so that's possibly why the overall market can continue higher over the next 12 or 18 months.
Those are some very interesting points, and my research has concluded a lot of the same things that you just mentioned here. Do you think during the 70s, we had the stagflation, we had higher inflation and higher unemployment, which the Keynesians said could never occur at the same time? Do you think in 1971 then, when the dollar was no longer backed by gold and they could just start creating literally almost unlimited paper fiat money, do you think then that took a couple years and that money started getting forced into the market and that's what started to create the bull market, despite the fundamentals you said in the 70s that weren't ideal for the market to be rising still?
Well, that's a good question. I mean, we did kind of have a little inflationary blow-off there in 1973 or 73 or so. The interesting thing is that bear market I'm looking at it right now from 73 to the middle of 74. That was because inflation was very high. The bear market started almost, I'm eyeing the chart, but the bear market started like 9 months before the economy actually went into recession. So, but to get back to your question, it's difficult to say. I'm actually sorry. Could you clarify the question for me again?
Oh, I was just asking about the flow of funds because, right now, if you listen to people who track flow of funds like Charles Biederman, they say that a lot of the retail money is leaving, stock mutual funds and it's going into bond funds, but then the stock market continues to rise. So obviously then flow of funds is coming from somewhere then back into the stock market, most likely from all the free money that Wall Street's being given, by the Fed and other central banks are giving to, institutions and stuff and large banks to speculate with. So that's where the flow of funds is coming from. So I was wondering if you think then that in the 70s, when the dollar was no longer backed by gold after 1971, when Nixon announced that gold window was closing, and, the derivatives market started to explode, and money could be created, literally out of thin air by the banks, if that's what triggered then the stock market to start rising after 71, it took a couple years maybe for that excess of money creation, which was allowed to be put into the stock market. Because, we had the junk bond market explode within, 6 or 7 years with Milken, and then we had the stock market go up then too. So maybe there is a big correlation there between the money creation and the junk bond market exploding and then the stock market also going up.
Well, I think the trigger actually in 74, I mean, thanks for getting me back on point, but I think the trigger in 74 was the market just got so oversold. And if you look at valuations at 1974, I mean, they were, I'd have to compare it to 82 because certainly valuations were very low in 82. But if you go back to 74, I mean, that was a very 60 or 55% bear market, and valuations were quite low at that point. And you have to remember, the market hadn't been right. I mean, the market was in a bear market for 8 years or so. Up to that point. So, I mean, this is something that I know we're talking about, Austrian economics and all that sort of thing, which, I am a proponent of that. But at the same time, I think one fault of the Austrians is we tend to get too negative and we're too, unless everything is perfect, then the economy doesn't look good and there's going to be major problems because everything doesn't look perfect. But, I mean, the fact of the matter is stock markets rise over time because of inflation and because the markets have what's called a survivorship bias, which is that weak companies get replaced by stronger companies, and that's what forces stock markets to, have an uptrend over, decades and hundreds of years. And one thing which we saw at the end of the 70s is because you were in an inflationary environment, and therefore the construction of the S&P was trending towards more companies that were going to benefit from inflation. So in other words, like looking at the stock market right now, I don't know what percentage, energy, materials, et cetera. I don't know what percentage those sectors are, but maybe they're 15%, and maybe 5 or 6 years from now, those commodity industries or commodity sectors are going to be 30% of the S&P instead of only 15% today. So that has an impact on the stock market. Because we're going to go into more inflationary environment, so more businesses that benefit from inflation, they're going to get moved into the S&P, replacing the companies that are going to be hurt by inflation, and therefore, that helps the market itself hold up in a difficult environment.
Yeah, I see an attempt from the powers that be, with the central banks and the politicians. They want a controlled stagflation, using financial repression, using the wealth effect to manage people's inflationary expectations. And like you mentioned earlier in the interview, when inflationary expectations and velocity of money start to accelerate like they did after QE2 announcement, they're going to try to jawbone the market. They're going to say, we're not going to do stimulus for a while. We may do it in the future, but we're not going to do it for X amount of time. And that's when commodity prices, violently corrected, that and the stuff that happened out in China, all the bad data.
Yeah, and a couple, just to end this part of the discussion, a couple of things I also want to touch on here. You mentioned bonds and also retail holders. I mean, the retail money has sold out of the stock market, so the weak hands are not in the stock market, and that's another reason why we're not going to see a 30 or 40% crash. I mean, that's just I don't see that happening anytime soon. I mean, maybe in a couple of years, but to have a big decline in the market, you need to have a lot of weak hands and weak money in the market. And as you mentioned, I mean, retail money in the last 3 or 4 years has been moving out of the market. It's also been moving into bonds, and so that's really where the big risk is that we have all this money in bonds, and bonds are very likely here. They could be beginning a secular bear market. And I think in the long term, that's good for stocks because money is naturally going to move out of bonds. It is going to move into stocks, and people are already realizing that. I mean, you can buy multinational companies that are yielding 3 or 4% or whatever, and that's just much better than owning a treasury bond. So that's another reason why stocks are doing well and why they may continue to do well over the next couple of years, or maybe over the next year or so. And also, more so in the short term, I think when we start to get a rise in inflationary expectations, as you say, money is going to move out of bonds, and it's going to move into, of course, gold and other commodities. And I think that's really, like, when we get into the bubble phase of this commodity bull market, it's really going to be fueled by that, by all this money is sitting in bonds, and that when that money gets scared about inflation, there's only one place they're going to go. And to me, that's really what's going to push, as I just said, push gold and other commodities into their bubble phase.
Yeah, and like you mentioned, I would much rather own a dividend stock like a Microsoft at around 3% dividend yield, which has cash flow. There's a lot less balance sheet risk from Microsoft than owning, sovereign debt. And I would much rather own that or an oil company like a Total or a Chevron or an ExxonMobil than putting my money in a sovereign debt at this point.
Right. Yeah, I would absolutely agree with that. And another thing, as we were speaking about before, is not only are high interest rates intolerable for governments, but also for companies. I mean, a lot of these companies who have borrowed tons and tons of money at low rates. I mean, if interest rates start to go up, I mean, this is something I'm not a complete expert on, corporations and their balance sheets, but if they've borrowed lots of money at low rates and rates are going up, I mean, that has to be negative for corporations also. So that's another reason why if interest rates are going to start to go up, the central banks are going to get into this bad cycle where, interest rates go up and they don't want to see rates go up that much. So when rates are rising, they have to try and print even more money to force the rates back down. I mean, it's just a total mess which could come in the next 2 or 3 years. And again, that's why all roads really lead to gold and silver, and secondarily other resources.
Yeah, I really agree with you there on the picks for your resources. Besides dividend stocks, which I think are consumer staple dividend stocks, which should be in people's portfolio instead of sovereign bonds. I think dividend stocks are good to hold instead of bonds. But switching to resources now, you definitely outlined there that precious metals should be separated from the other commodities, and I think that's an important point to make, especially with the data coming out of China and some of the data coming out of other developing countries, that this commodities bull market, it's not all going to be all commodities are going to rise equally at in the same amount. So the question for me then is which commodities are going to increase each year? They're going to keep up with the real inflation rate, or they're going to outperform the real inflation rate, because you're a mining stock analyst, you have a paid newsletter, so you know that the input costs for a lot of the miners, pretty much across the board, there's been very few companies that have kept their input costs under control over the last, year to 18 months.
That's definitely true. I mean, managing costs as far as, being a commodity producer is extremely important, and it's hurting a lot of the companies that aren't as well managed as the top companies. But just to get back to the first thing you mentioned, this is a really important point I want to make about gold and relative to the rest of the commodity universe. I mean, we know that gold is money, and gold, and we hear these people talking about jewelry demand and all that stuff, but I mean, you and I know that gold is driven entirely by investment demand. Supply and demand for gold have much less of an impact. I mean, it is a psychological investment, and if investment demand is rising, as we've seen in this bull market, that's what pushes gold to higher and higher prices. And so it's less so supply and demand. Now, silver is 50% an industrial metal, 50% a precious metal. So some of that applies to silver, but some of that does not. And looking at the rest of the commodities, they're less affected by investment demand and more affected by supply and demand. So what does that mean? Well, for example, you see silver was at, I guess, it hit a low of $8 back there in 2008, and it goes all the way to 49 or 50, and we hear all these people screaming about manipulation and that sort of thing. Well, I mean, Jason, if you're a silver producer and you see the commodity that you're producing goes from 8 up to 50, I mean, you're going to be trying to pump as much silver as you can. Or I shouldn't say pump, we're not talking about oil, but you're going to be trying to dig as much silver as you can out of the ground when silver is at $40 or $45. And so essentially what I'm getting at is, I mean, there's a strong supply and demand component to a lot of these commodities where there isn't for gold. And that's why gold has essentially gone straight up with, I mean, it has had some pullbacks, but it hasn't, the chart hasn't completely fallen apart like we saw with oil and copper in 2008 and, some of the other base metals. So to get back to just reiterate that point, these commodities are very economically sensitive. If oil goes up to, $150 again, a lot of companies are going to be doing everything they can to produce more oil. And then eventually, more oil comes on the market, and oil can't go higher unless we see a huge increase in demand. So I think that's something that people have to remember with, copper and oil and these other commodities. They're very economically sensitive. Where prices go up too far, too fast, they're going to come back down because supply is naturally going to go up. Now, you look at gold. Gold is just investment demand. I mean, sure, it's less affected by supply and demand. I mean, it's gone from 250 to 1900, yet we haven't even seen a huge increase in production. I mean, there's other reasons for that, but it's less. I mean, the point is, gold is far less impacted by production and supply than these other commodities. I mean, higher prices in gold are not bringing down, or they're not bringing more production and supply to the market. And again, silver fits half with gold and then half with the other commodities.
Yeah, I think silver's volatility, compared to gold, silver just has way more volatility, and it's because of the industrial demand, like you said. And gold and silver, compared to the other commodities, they're two of the only things I've ever seen on the planet where if the price goes up, people want to buy more of it. So you can't really say that about like an iPhone or anything else like that, available for consumers. But when gold and silver price goes up, the phone goes off the hook at the retail bullion place like an APMEX or one of those other places, and they're sold out. And then no one wants to buy at the bottom, which is when like when silver was around 26 and no one wanted to buy any physical silver at that time. It's just really funny about human nature and emotions.
Absolutely. I mean, it's everybody was forgetting about gold and gold stocks 3 or 4 months ago. I remember I wrote an article in May where I really thought that I titled it something about major bottom could happen this week, and we did actually hit a price low that coming week, and it did take the market several months to before it really started moving back up. But I just remember writing that article and putting it on my website, and some of the comments on my website from people were just so ridiculous and so out of line. I even had to delete some of them.
Contrarian indicators,
yeah,
my friend.
Exactly. It was
I got hate mail too. I got a lot. I got hate mail. I got a ton of stuff too, saying how could you, in your right of mind, how can you tell people to buy it here? It's gonna go down further. There's no bottom in sight.
Well, at that time in May, there was very, very strong evidence. It can take a little while for bottoms to form. You really have to, especially with gold and silver and the mining stocks, you really, some of these major long-term bottoms, you really have to wait for things to get not just very oversold, but extremely oversold. And again, that's what we saw in the mining stocks and the gold and silver stocks in May. The valuations at the recent low were comparable to what we had in 2000 and 2008. So the GDX, I'm looking at a chart, sorry to interrupt you, I'm looking at a 5-year chart of the GDX, and it bottomed right around there, around 41.78, and it's up to 53 already, which is a pretty good move for the GDX, considering, it's larger companies that have less growth. I bought, like you said, around that time period, Brigus Gold was around 73 cents, and I bought it then, and I was up 40% when I checked yesterday already, and, the company's just starting to turn their Black Fox mine production around. Well, that can happen. Or I shouldn't say that can happen. That does happen off of bottoms in the mining stocks. You see very substantial rebounds in percentage terms coming off those lows. And not just a quick point that I want to make is that the momentum in also the metals, but particularly the stocks. Typically, you see very strong momentum. It's kind of a warning sign when a market has been going up for a year or 18 months or whatever, and then you kind of get strong momentum at the blow-off point of a move. But what we've seen now is very bullish, and that's we see the market bottom in May, and then it's going to look like a double bottom on the long-term charts because it did rally for a little bit, and then it retested that low, I think, in early August. So we have a strong bottom, and coming off the second bottom, the momentum indicators have really shot up for the metals and the shares, and that's very bullish when you're coming from a low. Because when you're coming from a low and you have such very strong momentum, that means that the move that you have is going to be sustained in the near future. So I'm kind of looking for, October can typically be a rough month, and I do think we're starting to run into a little bit of resistance in the metals and the shares, but I think it's nothing to worry about really, beyond the next couple weeks. And after a little October pullback, we could be setting up for a move back to the highs at the end of this autumn or early winter.
Do you expect GDXJ and SIL to outperform their bullion counterparts on percentage returns over, say, the next 18 months?
Over the next 18 months, that's difficult. I would say yes, because now let's just go back a second. A lot of people are, they think it's a sign of manipulation, the fact that a lot of these companies these indexes have been struggling to outperform the metals. But if you go back and look at the 1960s and 70s bull market, the Huey Gold ratio is following a very similar path. Particularly where we are here, kind of 2/3 or 3/4 through the bull market, and at this point. I do expect the stocks to continue to outperform. And I think the reason is because a lot of the inflationary cost pressures they're kind of subdued right now. And so I don't see cost pressures really kicking in probably for another, who knows, maybe 12 to 18 months or so. And, one thing we have to understand when we're looking at, GDX, GDXJ, SIL, et cetera, gold and silver mining is a very difficult business. It's kind of a bad business to be in. Even when the fundamentals for this sector are very good, that doesn't mean that. A lot of these companies are going to have problems, and they're going to underperform the metals.
The mines have.
Sorry
to interrupt you. The mines have so many moving parts. This is what most people don't understand. They think it's easy to get a mine into production, and even when the management team has an experienced track record, there's always one thing that could go wrong, like the mine could start flooding or whatever.
Right, and that's why you can use these ETFs. I use them to track the market, and you can also use them to trade the market. But you really need to be a stock picker in this sector, and because there's a lot of mediocre companies out there. I won't say bad companies. I'll just say mediocre. There's a lot of mediocre companies out there, but there are some that are very good, and they're going to outperform the metals consistently because they have consistent growth, and their operations are consistently performing well without major problems. So those, you need to be a stock picker in this market, and those are the companies that you need to try and find.
Yeah, for actual gold miners, like with the caveat that we're not talking about the royalty and streaming companies like a Sandstorm Gold or Silver Wheaton, because those guys don't actually do any of the mining. They just pick out good management teams and they make good investments and their business models are efficient. But they're really just banks. They're basically bullion banks that are making smart investments into mining companies and are not actually doing any of the hard work, doing all the crazy stuff that needs to be done to get a mine into production.
Right, I would agree with that. The royalty companies have been on an absolute tear recently. I don't know if I would buy them here and now, but if we do get, as I'm kind of expecting, if we do get a consolidation or a pullback over the next couple weeks, I would certainly take a look at the royalty companies if I didn't already own them.
Great. Last question here before we wrap up the interview. What type of price targets here do you see for gold and silver in the next, 2 years? And do you think they're going to be dependent entirely on more stimulus, or do you think even if there was no more stimulus announcements, do you think gold and silver will definitely both rise?
Well, the next 2 years, that's kind of difficult. I do I could give my near-term targets first, which is I'm looking for. I think gold can hit 2,300 sometime in the next, maybe around the middle of next year. I mean, it could be in the spring, it could be in the third quarter. I mean, as far as 2 years out, looking, when gold had its last low at the end of 2008 around 700. 2 years after that, it essentially doubled to 1,400. So if you take a doubling from 1,550 or whatever, that would be obviously about 3,000 or 3,100. 2 years from that point would be sometime in 2014 or probably the end of 2014. So I mean, I do think obviously many things can change in the next 2 years, but 2,300 I think is a very strong target, and I guess my 2-year target would be 3,000 or possibly up to 3,300. I think there's a strong Fibonacci target there. I might have to look at my charts again. As far as silver, I think silver's if gold goes over 2,000, silver is very likely to go back to 50. As far as targets after that, I mean, silver is forming kind of a cup and handle pattern here, and so when it gets back to 50, it's going to have this giant cup, which I mean, looking at that, you'd have a target of about maybe 72 or 73 or so. I don't know if it can hit that mark in 2 years, but 2 years from now, I do think silver within the next 2 years is probably going to break past 50. So with silver being at 34 right now, I'm more focused on, I guess, $50 as a long-term target. And as I said, if we see gold go over $2,000 an ounce, I think that means silver is headed back to at least 50.
Yeah, I think in the next 12 months for sure, I think silver will definitely at least test 50. I'm not sure if silver will go over 50 on the next try again, because 50 is really the hardest hurdle left that silver has. Because, it's never been over there. It's literally uncharted territory after 50. So, it could take 3, 4, 5 tries for silver to go over 50. So that wouldn't surprise me how many times it would take for silver to try to go over 50 and then correct back to 35 or 40 and then, make another attempt at 50. I think 50 is going to be pretty difficult for silver to get over, but once it does, I think it could really go higher faster after that.
Right, and one thing you have to, our listeners out there have to remember, I mean, when I'm analyzing companies and I talk to CEOs and so forth, I mean, you got to remember where they were a couple years ago. We had, or 2 or 3 years ago, we had, silver below 20, and now silver's at 35. So a lot of these companies are really, really happy with where silver is right now. And so if you tell them, I mean, if you're like we were talking about before, if you and I, if we're running a silver producing company, I mean, we're with silver at 34 right now, we're going to be ecstatic if silver, gets to 42 or 45 or even 50. So these companies are going to, if we see silver go back up to 50, these companies are going to dump a lot of silver on the market at that point because they're going to make tons of money at that price. And that's why, some of these people, they like to talk about manipulation. I mean, there is some manipulation, but it's really not important. I mean, what we need to understand is that there's companies that produce silver, and they're going to supply the market if the price goes back up to 45 or 50, and that's why it takes a long time to break through that, because you have to see an increase in demand that overwhelms the new supply coming to market.
What I've been trying to stress to people who follow our work is that I expect a lot more volatility in gold and silver prices, and also mining shares, and that yes, the long-term fundamental, the secular trend is higher, like I think you and I both agree with. But I think what could happen, is if gold does go to 2,300 or silver does go to 50 or higher, I think people need to make sure that they take some money out of positions off the table and keep cash or buy bullion just in case, you have a correction and you have some capital then on a correction if the market panics and like for example, First Majestic Silver, which touched $30 and it dropped back down to 10 in the last, 12 months, I think. After it touched 30 and then it dropped back down to 10, you want the cash from selling it at 30 to be able to buy more shares at 10 and accumulate that way.
Right, yeah, and also particularly when you're, I mean, this is something I talk about in my newsletter, but particularly when you're dealing with, development companies and exploration companies. I mean, all non-producing companies, they don't sustain. I mean, these are not real businesses. Most of these companies are looking to, prove up a resource, maybe get a mine in production, and then be acquired by a bigger company. So these companies are not real businesses. They're significantly leveraged to the prices of the metals, and what that means is, when we have a correction or a little downturn, I mean, these stocks go down 70 or 80%. So when you're dealing with these companies, these are not long-term holds. This is something you have to, have maybe a 1 or 2 year time frame on. You got to look to get rid of that. Now, conversely, you're dealing with growth-oriented companies like a Silver Wheaton or a First Majestic. These companies, they're going to continue to make new highs over the next 3, 4, 5 years. But as you mentioned, I mean, it can be very painful to hold through. You get a little cyclical downturn. I mean, that's a lot of pain right there to hold through. So when these stocks get really extended and well beyond their long-term moving averages, I mean, that's when you have to be careful and take some money off the table and just exercise some patience.
Exactly, and I think you made a really good point in distinction between the cash flow producers or a royalty or streaming company and the junior explorers that are sometimes 5 or 6 years or longer away from production, and they might have, they have a couple good drill holes, or they might have a 43-101, they might have a good resource out, but, they haven't done all the economic projections, and they're nowhere near raising hundreds of millions, if not a couple $1 billion for some of these deposits to build a mine. And I've followed a lot of these juniors for a while, and some of them on paper look to have good deposits, but the market is paying a premium for cash flow, and you don't want to be holding the bag if the management team screws up a financing or forgets to finance in an Extori Gold type situation, where the stock, I think Extori Gold got to 14, and the management didn't do a financing when the stock was up there, and then the stock crashed back down to 2, and then the management team, basically panics and sells out at 4. So that's not a situation where I want to be putting a lot of capital in. You got to trade those, like you said, basically like a biotech stock kind of.
Yeah, exactly. And when at a company like that, Extori, these development companies, when they, do you see a development company trading at $15 or $20 or $25? No, you never see that. When these development companies are moving from 50 cents to 5, 6, 7, 8, $10, at that point you got to sell, because when you're dealing with these non-producing companies, do you really want to try and stick around to make another 50% or 100% on the stock after it's already gone up 5 or 10 times? It doesn't make any sense.
Yeah, the risk reward, like I think you pointed out there, the risk reward is just not good. You already have a couple 100% returns there on your money. And I've done this. I've had a couple 10-baggers, although one of them was with Great Panther Silver, and that was a producer. But they had growth, massive production growth at one point. And it's not worth it. The risk reward, once it's already gone up a couple 100%, you should maybe do what Mickey Fulp says and take half your position off the table, and then keep some cash if you still like the company and it crashes 70 or 80%. You want some cash.
Right. Yeah. That is a smart strategy to employ.
Okay, well, in wrapping things up here, Jordan, I think you gave our listeners a very good summary of how you see the gold and silver markets playing out in the next 18 to 24 months, and you gave us some good opinion on the general market. And I think our listeners are going to be very happy with your insights in the gold and silver stocks. So if you have anything else to add, give you a couple more minutes to talk about your newsletter and any last comments you have.
Well, you can find my newsletter at thedailygold.com. That's my website, and we have a premium newsletter, as we've discussed here. Also, twice a month I do updates on other sectors, just because it's important, because bonds and currencies and all those things, the macroeconomy, they also impact gold and silver. As far as a quick thing on intermarket analysis, bonds. The bond price has consistently topped 1 or 2 months before major bottoms in gold and silver, and so that was something that we've been watching, or we were watching earlier this year for quite a long time, and it kind of helped us confirm that May was going to be a major bottom in the sector. And I guess another thing I would mention is, I mean, as we were just talking about, I do try and focus. I focus on growth-oriented producers. I know, Sandstorm. I know that's one that Jason has owned. It's been a great stock for us for the last few years. I focus on cash flow producing companies like that, and then also focus a little bit on the exploration and development companies. Try and separate them because the latter, I mean, those are more speculative, whereas the cash flow producing oriented types of companies, they're less speculative. So with that being said, Jason, thanks so much for having me on. I really appreciate it.
Thanks, Jordan, and we'll try to have you back on in another few months here for more insights on the commodity markets and precious metals.
Thank you.